Hello, my little day traders. Today I'm going to be going through some trading cards on technical analysis. So let's get into it. So if you are new here, we're going to be learning day trading together. I am a newbie, so I bought these cards, and today I thought we could go over maybe 10 cards and learn something new today. Let's get into it. Okay, the first card. We're going to be talking, here is the first card. We're going to be talking about market trends. So if we look at this close up, you can see there is an overarching trend, which here is called the primary trend, the black line that you can see that's going through the entire thing. This is basically the overarching trend, the long-term trend, the trend that you should be paying attention to if you're going to be trading on higher time frames. Then there are short-term trends. So as you can see, that's the pink line. These are tiny trends that are happening maybe on the minute time frame. And then we have the intermediate trend, which is the gray line. That is probably one that you're going to, that is probably the trend that you should be trading on maybe a higher time frame, maybe a 10-minute, a 15-minute, a 30-minute, possibly even. And then when you get into higher time frames, the 4-hour and such, then you're going to be trading on that bigger time frame. Let me read this card. Let's read the card and see what it says. It says it's important for all participants. So for marketing trends, here's what it says. We have the short-term trend, the intermediate trend, and the primary trend. It's important for all participants to possess a solid understanding of these three trends. Primary trends typically go on for 1 to 3 years and occasionally even longer, showing how investors perceive the business cycle. So that's that big trend that we're looking at. Intermediate trends, which last around 6 weeks to several months, aren't the main force behind the market, but it's vital to recognize them correctly. And like I said, if you're trading on a shorter time frame, which as day traders you are, these are the ones you're going to want to look at. And then the short-term trends spanning 2 to 4 weeks are often random and a bit unpredictable. I feel that. Let's check out the next card. This card is called the high to low dilemma. So as you can see, there is the up, down, and you're kind of making either these higher or these lower lows or higher highs if it's in reverse. This one in specific is lower lows. All right, so let's read the card and see what we learn. When the stock makes a lower low, we face a dilemma. Although a bullish trend should still be seen as bullish, the fact that the upwards movement has been halted reveals technical weakness. How should you interpret this? The decision hinges on the collective evidence. Traders need to take into account moving averages, indicators, volume, and market sentiment. Even if all these indicators continue to look bullish, it's prudent to maintain some skepticism due to the weakening trend strength. All right, so if you see something like this, be sure to take a second thought and not make any sudden. So it seems like in a trend like this, you want to be a little bit more cautious. Corrections. The next card we're looking at is called market corrections. As you can see from the card, the market corrections look like a trend is going in one direction, it pulls back and then corrects itself, in simple terms. Stocks never move in a straight line. They're filled with advances in corrections. Once the correction ends, an upswing starts. Knowing when a correction is over is vital for successful trading. And it says typically these corrections cover a range between 38% to 61%. Sometimes they might not reach 38% or go beyond 61%, but most often they stay within this range. Let's get closer so you can really see. This is the range that they're talking about here. You can see the yellow box is what the card is speaking on. All right, we have another card. This card is called price volume relationship. So here at the bottom of the card, you're going to see the volume indicator, and up here you will see the actual stock market and the candlesticks. Okay, so this card says usually when price goes up, trading volume increases, and when price goes down, volume tends to drop. If you notice volume getting quiet during an uptrend or picking up during a downtrend, it could be a sign that the current trend might change soon. Keep in mind that because the real proof of trend shifts comes from a collection of indicators and watching the price of those averages. So if there is an indicator that you want to use, the volume indicator is a really, really good one. I've used this one before. Okay, the last card we're gonna go through today is the resistance and support. This is a big one that I think a lot of people talk about, so let's get into it. Okay, as you can see from this card, there is a resistance line and a support line. Then you can see the trend is in between those lines. Stock can trade within a price channel defined by resistance and support levels. When the price touches the resistance, it often faces a temporary reversal because buyers are reluctant to pay a higher price. And the increased price attracts more sellers, making it challenging for the stock to break through. A similar dynamic occurs with the support line, where prices become appealing to buyers who missed the previous upswing, and sellers resist selling at a loss in anticipation of higher prices. So I hope you enjoyed this video. I hope it was helpful to your journey, and be sure to subscribe to learn more about trading with me. And with that all being said, I'll see you in the next video. Bye.